guys, here is our first acquisition in Fund V. Happy to share here that we have the Westmoreland and Walpole, New Hampshire storage facilities, Riverview storage facilities with beautiful storage right here in the western part of New Hampshire. We own quite a few assets out here. I'm in New Hampshire now, wrapping up the new year. The asset is around 33,000 square feet. There's not a lot of competition. So we have the small garage here on the front, 2 buildings in the back, and then we have the commercial building with the apartment above it. Good looking storage. We rent the apartment and we rent the commercial building to an engineer. He's been a long time tenant there. So that's going to be a strong tenant for us. And we are already negotiating the leases and increasing the rents by 10 or 20%. We'll go over that in the model. Plus, we are in the heart of town. I know it doesn't seem like there's a lot of people here, but people do commute to the heart of town here from other smaller towns, especially on the Vermont side. There's a little more population in Vermont and then also in the New Hampshire side. So there's some employment here with different manufacturing. We'll go over the supply and demand as well. But we're on a good, well-trafficked road going north and south, and conveniently located on the south and north end of these 2 towns. So this is the second location. It is paved, really good visibility off the highway, good traffic going up Highway 12. That's one of the main highways going north and south here. We are going to look at buying some additional land in the future up here, but for now, plenty of storage, and we'll look at the model. But good looking facility, and it's got lots of visibility. So you're going to get plenty of traffic looking at it. So we have roughly 34,000 square feet, 239 total units. It's 2 storage facilities in New Hampshire. We have 22,000 square feet at the southern location, 6,300 square feet of storage at the northern Walpole location, and then we have the 5,500 square feet of the office, apartment, and that wooden shed. These are all rentable units. These are the current market rents, $10, $10.90, and $7.62, and we'll get into it. We love that. That includes all the capital improvements, so we'll be painting it, lighting it, fixing up the doors if needed, fencing, signage, cameras, everything we need. Plenty of CapEx. I think we went heavy on this, but we have more than enough. Here's the breakdown of the CapEx. Lighting, the conduit underground, security cameras, we have the signage. Our total cost basis, $2.96 million, $87 a square foot for the 34,000 square feet we're buying. The loan that we got on the property is 74% of total loan to value. The total equity is $922,000 because we did finance the capital improvements and we did finance some of our reserves. So our interest rate is 6.95% on a 25-year AM, 12 months of interest only period. So the first 12 months is interest only. Our monthly payment will be $14,600 a month based on our $2 million loan amount, and our closing costs ran us around $189,000. And here's our capital improvements, and we always keep reserves in the account. We have $40,000 of reserves, which are helpful for us to just make sure we pay the bills and have a nice buffer in the account. So the current occupancy right now is 68%. So we have to fill up the facility about 20%. We like to stay at 90% occupancy, as you can see here. And this is the stabilized occupancy. This is where we want to be at 90% occupancy, and our rents are going up significantly. This is the key to this deal, and we are going to raise these rents over the next 18 months. This is how we create value. And the reason we can do this is because there's a lot higher rents in the area, and there is very low supply, and there is a demand for storage. So these are why we like these assets, is we know the area as well, and there's very little competition. Getting the rents to this blended rate of $15.68 generates all the yield. So we start out at buying the asset at roughly a 5% cap rate, and then we get to year 3 about 9.3% cap rate. So within that first 3 years, all that revenue increases, drives the NOI and drives the value, and then that gets us to our target of that 8 to 9% cash on cash return in year 2 and 3, which is excellent. And this gets us over to the project equity multiple of 2.8 and a project IRR of almost 28%. And this is on a 5-year hold. So investors keep 70+% of this, almost 80% of it when you add in the preferred return of 8% each year. So they're getting roughly a 2.5-time multiple and a 24% IRR, which this is being bought in the fund. It's a great fund asset. It meets our targets over 20% for the investor. Good 2.5-time multiple, very low risk because we don't have to build any storage. We don't have significant second lease up. We're already at 68% occupancy, so we can lease up the rest of the property relatively quickly over the next 18 to 24 months. And we're raising rents dramatically over the next 5 years because we know the market well. We're looking at operating at around 47% expenses, which is high, but this is in New Hampshire. You have a real high property tax. If you can see here, property taxes are going to double as they reassess. Also, we go very heavy on advertising. This is really, really critical that to get the high rents, we got to make sure we advertise on Google, and we are number one. We're investing in that, $20,000 a year. And then snow removal, typically in New Hampshire, it's going to be a lot higher than other states. So that's almost $10,000. Payroll, management fee, repairs and maintenance. So we are well buffered here on the total expenses, and it still is going to generate a solid yield for us, a stabilized cap rate of 7%. But then after we start to increase the rents, and this is with the apartments and the office and everything leased out, wood shop, that's what gets us to a pretty strong cap rate at 8.26%. And this is within the first 18 to 24 months, getting us to a total gross income of $440,000. But to wrap it up, guys, here is the exit assumption. We sell at a 7 cap in 5 years. There's a 3% disposition cost. There's some state income tax, and there's some money held back for some of the improvements if just in case we need to make any more along the hold period. The target is to sell at $4.237 million. We would make a total of $1.236 million as profit. We are investing $900,000 and change, $922,000, and over the life of the asset, we'll be distributing back $2.6 million. That includes repaying back that $900,000. It is a strong return, and I think it's a very low risk. So we are heavily covering our debt. Once we get rents even close to where they're supposed to be, we'll be at a 1.2 roughly debt coverage ratio by the time we hit year 2. And it'll take us the first 6 months to be able to make sure we do cover the debt year 1. And that's just going to be filling up the rest of the facility here throughout the summer. Our assumptions on filling this facility are 1,000 square feet a month on average, which is a safe assumption. In a hot market, it's roughly 2,000 square feet a month. In a really slow market, it's about 500 square feet a month. So more conservative side of this. And that's equates to about 12 units a month, 10 to 12 units a month. So we feel confident we can get that. And that's going to get us right where we need to be to generate this higher yield. Great asset, low capex, already built, in good shape, good location, good visibility, good demographics in the area. We have strong rents as competitors. I'll be doing these on every asset. Glad to have this deal going and glad to have you in the fund. We're very happy because we're patient, disciplined. We're going to find more deals like this because competitors are just falling out of the race. They can't close on deals. Sellers are actually wanting to sell, not going to want to manage their properties like they did before, certain motivated ones. So now is the time where we're going to pick up a handful of good assets, ideally each quarter, but our goal is 15 assets this year in Fund V, raise the $25 million and hit our 2.5% and 20+% IRR for our investors. Recession-resistant asset, mobile home parks, and storage facilities, hyper-focused on this. Thanks. Keep you updated on the next great deal.